If you own rental property in Katy, Texas, or the greater Houston area, this might be a little bit of an uncomfortable conversation, but it needs to be said, and here I am. If your investment property does not hit the 1% rule in today's market, which I know is hard to get, you need to ask yourself a few serious questions. Why are you still holding it? So the 1% rule is simple. A $400,000 property should generate $4,000 per month in gross rent. It's not a guarantee of profitability, but it is a fast performance filter. So now let's apply that 1% rule to Katy. Right now, many single-family homes in the $375,000 to $500,000 range are renting between $2,600 and $3,400 a month, depending on neighborhood and, of course, condition. That means most of them are not hitting the 1% rule. And that's before we talk about expenses, which is a big thing. So let's break down the math using real Houston area realities. Property tax rates in Katy commonly range from 2.3% to 3.2%, depending on the MUD district. Insurance premiums in Texas have increased dramatically over the past 2 to 3 years. Maintenance costs have risen, vacancy risk is higher, and interest rates are significantly higher than the pandemic era of financing. So if you bought in 2020 or 2021 at low rates, you may still cash flow. But if you purchased recently or refinanced at higher rates, many properties are barely breaking even, or worse, coming in negative each month. So here's the real question. Is your property producing a competitive return compared to other options available right now? Because today, capital has choices. High yield savings accounts are paying real returns. CDs are paying real returns. The stock market is offering opportunity. Private lending is offering opportunity. And meanwhile, some investors in Katy are holding on to properties with minimal cash flow, high maintenance risk and exposure, increasing tax burden, tenant turnover risk, and they're doing it because real estate always goes up. Not that it won't. But yes, long-term appreciation is powerful in Houston, but appreciation alone is not a strategy, especially when your equity could be deployed into something performing stronger. So Mark King used to be the CEO of Keller Williams, and he challenged investors to hold their capital accountable. That means every dollar must justify its position. Not emotionally, not nostalgically, just mathematically. Let's say you have $200,000 in equity sitting in a rental in Katy that nets you about $400 a month after your expenses. Yay, right? That is $4,800 per year. That's a 2.4% return on an equity. Would you intentionally invest $200,000 today for a 2.4% return with tenant risk, repair risk, and tax risk? If the answer is no, then you are not investing. You, my friend, are babysitting. And in today's market, babysitting capital is expensive. Now, this is not a blanket sell everything message, obviously. This is a performance review message. Run your numbers. Calculate return on equity, not just cash flow. Factor in taxes, insurance, maintenance, vacancy, and management costs. Then compare it to alternatives available right now in 2026. If it competes, yay, keep it. If it does not, consider allocating. Sell that property and put it somewhere else. Because smart investors in Katy and the greater Houston area are not loyal to properties. They are loyal to performance. And this market is separating disciplined investors from emotional ones. If you want help reviewing your rental property in Katy, or Fulshear, Richmond, Cypress, the greater Houston area, I will run the numbers with you. No hype, no pressure, just the facts, just the data. Because smart money does not babysit underperforming assets. It reviews, it cuts, and it reallocates. And that is how wealth compounds. Thank you for joining me today. Hope this was helpful. Bye.